Hello, my name is Justin Beaton. I'm the Managing Director of Tailored Investment Solutions. Today is an advisor briefing on our upcoming investment opportunity, which is called Tailored Investment Solutions Berkshire Hathaway Units Series 3. As an investment manager, fund manager, financial planner, as an individual, I've somewhat tried to replicate Warren Buffett for 2 decades that I've been advising clients for. Replicate his investment philosophy, try to replicate his returns. And in 2008, 2009, I recognized that to replicate Warren Buffett-like returns, it's quite easy. All that we need to do is invest in Berkshire Hathaway shares. It's 99% of Warren Buffett's investment is held, or wealth is held, in Berkshire Hathaway stock. However, when we look at Berkshire Hathaway, the share price is currently trading at $258,000 for one share. So because of the purchase price, the share price, it puts it out of reach for most investors. Even if you're lucky enough to have clients that have over 250 grand to invest, to buy one share is a huge barrier to entry for most investors. So back in 2009, I sat down and put together my first structured investment that gave a client and me as an individual investment exposure to Berkshire Hathaway, where we didn't need such a large outlay. And at that time, I wanted to incorporate some of my expertise, which has been developed over the last 2 decades, which was capital protection. And when we have capital protection, we can then look at incorporating leverage. So I'm going to go through the ins and outs of my investments and the reasons why I developed the structured investments in the first place and why I'm coming out with another structured investment linked to Berkshire Hathaway right now. Before we go on, look, it's important to go through the important information on the disclaimer. Tailored Investment Solutions is the issuer of this product. I've prepared this presentation for advisor use only. It's not to be distributed to retail clients. The investment, we've got a product disclosure statement. Retail clients can invest. It's open to retail investors. It's not limited or restricted in any shape or form. Just this presentation shouldn't be passed on to retail investors. Past performance is not necessarily indicative of future performance. I'll go through the past performance of the last 9 Berkshire Hathaway investments in a moment, because the investment has been quite stellar when we refer to the returns that has been produced. There we've got it. Look, my previous company, while I sat down in 2009 and constructed the first ever structured investment to be linked to Berkshire Hathaway in Australia, it took me a few months to actually put together the product disclosure statement and launch it to investors. The commencement date was actually in April 2010. All of these investments are a closed-end investment linked to Berkshire Hathaway for a 3-year investment term. Now, every quarter investors can redeem, but that's more of a profit-taking mechanism. There's a set close date up front, then we invest at an investment commencement date, then in 3 years' time, it's a maturity date. That 3-year period is when the capital protection matures. So in April 2010 was the first commencement date of the first ever Berkshire Hathaway structured investment I put together. 3 years on was April 2013. Now the Berkshire Hathaway share price was 29.68% over that period. However, our investment returned 63.37%. The reason of the increased return for our structured investment over Warren Buffett's performance was simply because of the leverage. And I'll go through the key characteristics of the investment in a moment. So if we go through July 2010, so every quarter they're about to have had demand for the investment over the first few years of the investment date. So we launched in April, then the second one in July 2010. That matured in July 2013. Berkshire Hathaway share price over that period went up by 38%, yet the investment return was 94, it's close to 100%. Again, the reason of the significant outperformance was due to the leverage. October 2010, maturity October 2013, Berkshire Hathaway share price was up 39%, we made 95. January 2011 was the next one. The share price was up 33%, investors made 50%, which is actually the worst performing investment of the Berkshire Hathaway structured investments I've launched. So it's pretty good over the last 8 years that the worst performing investment in what is 10 has made a 50% return over 3 years. April 2011, the return to investors was 109%. 2011, the share price was up 67%, but the investment, the structured investment, was 202. Again, these outperformances as a result of the internal leverage built into the products. July 2014, which is the first one that we issued under Tailored Investment Solutions branding. It's yet to mature. It matures in July 2017. So around 2.5 bit further, 2 3/4 years into that investment. Berkshire Hathaway share price is up 30%. Yeah, the performance on the structure, the cash on cash return for investors, 65%. And then June 2015, which is Series 2 under Tailored Investment Solutions, it's got another year and a quarter to run. The share price is up 24%, yet investors' return is up 68%. So we go through all of those investments of the past Berkshire Hathaway investments that I've put together. The average return is 93.58%, making these investment structures one of the best performing investments in Australia, which is phenomenal. But a lot of people go, oh, you're a bit of a genius in what you put together, and you go back to 10 years ago, or 8 years ago, we gained a fair amount of publicity coming out with the first structured investment over Warren Buffett's company. But all that I'm doing is investing 100% of the capital into Berkshire Hathaway, choosing an underlying asset that has had a 55-year record of providing 20% return as an average annual growth. So when we look at investment, we look at underlying assets and then we overlay a structure, which is my expertise. I look for underlying assets that have got historically a long track record of providing superior returns to investors. And there is no better underlying asset than Berkshire Hathaway. So while past performance is not equal to future performance, I suppose when we look back over history, the longer and more consistent the returns, the greater probability that those returns are going to be replicated in the future. So Berkshire Hathaway is the best investment vehicle in the last 50 years, without question. It is run by this man, which is Warren Buffett. Warren Buffett was born August 30, 1930, so there's nothing to hide that he's getting old. He's 87 years of age. All he does is invest. He is known as the Oracle of Omaha, the most successful investor of all time. He's ranked as the second wealthiest man alive, second to Bill Gates. He was the wealthiest person in 2008, and he is biting at the heels of Bill Gates. Maybe in the next few years, he'll surpass Bill, depending on the performance of Microsoft and that of Berkshire, of course. He's known as one of the most influential people in the world. If we go look at the Berkshire Hathaway performance, this is from the front page of his 2017 annual shareholders letter. It goes through the increase in the per share book value of Berkshire Hathaway since 1965, which is when Warren Buffett took over Berkshire Hathaway as a company. The average compounded return is 20.8%. Well, what's important here is that if we actually look at the years that the average, the book value in Berkshire Hathaway has gone down. So over the last 50 odd years, 52 years, there's been years that the market has fallen significantly, whether it's the dot-com bust, September 11, the global financial crisis, the oil crisis, 87 crash, right, the Asian banking crisis in the 90s. There's been every 5 to 10 years a massive correction on the share market. Despite Berkshire Hathaway being listed on the share market and the majority of its investments being listed on the share market, the actual book value of Berkshire Hathaway has only declined in 2 years. If we look there in 2001, it fell by 6.2%, and then 2008, it was down 9.6%, despite the overall market, the index of the United States, being down 31.8% in that year. So there's 2 years out of the last 50 where 52 years that the actual book value of Berkshire Hathaway has declined. Now, if we go back into the 60s and 70s of some of the performance, like we go back to 1976, it increased by 59%, 35% in 79, 40% in 82, 32%, 48%, 44%, 39. So if we look at the returns on the upside on an annual basis, there's years that the actual book value of Berkshire has increased significantly. So as we can tell by the returns in the positive years, this is a high growth investment vehicle. However, the downside on the book value only declining twice, it doesn't really represent the high risk nature of the share market. So we get the upside of the share market, not necessarily with the downside. Over the last few years, what Warren Buffett has talked about as one of the hardest things to replicate the returns that he had previously was the sheer size of Berkshire Hathaway. The sheer size of Berkshire Hathaway now being the fourth largest company in the world, it's probably its biggest problem. It's hard to find great valued companies which are going to have a material impact on the share price and the profit of the company. It sits on almost $100 billion of cash right now. Warren Buffett needs to make what he calls elephant-sized acquisitions to ensure that that money is wisely spent to have a high impact on the underlying share price. So despite Buffett saying that the returns of the past, certainly in the first 25 years of operating, cannot be replicated, if we look down the last 10 years here, like in 2009, the returns was 19.8%, 2010, 13%, 14.4%, 18.2%. So if we look at that in the last few years, despite its sheer growth, it's still a great return. Like if I'm able to achieve 14%, 18% of return, I'll be doing cartwheels down the street. I'll be pretty happy. So despite the sheer size of Berkshire Hathaway, the returns have been very strong over the last 10 years. I'll try to get rid of those racial drawings. There's the share price since the 90s. As we can see, it's increased dramatically over the last few decades. Now, we came out with our first investment with Berkshire. The share price is at $90,000. And many people, even in the media, said, hey, the share price isn't going to go above $100,000. It did. Then the next few were around 140,000. People go, it's not going to go above 150,000. Then up, the next one was about 180,000. It's not going to go above 200,000. And then just more recently, they said there's no way Berkshire Hathaway share price can go through $250,000 for one share. Now it's sitting at 258,000. So anyone that's tried to pick the top of Berkshire Hathaway or tried to time the market has soon been proved wrong. And that's simply because what Berkshire Hathaway is a play on the overall global economy. More importantly, it's a play on the American economy. Anyone that's tried to pick the top of the American economy has soon been proved wrong. The average annual return, 20.8%. There you go. If a dollar invested in 1950, invested in the S&P, the US stock market, would be worth almost $1,000 today. Whereas if you invested $1 in Berkshire Hathaway, that'd be worth over $1 million today. Now this chart here is not to scale. As we can see on the y-axis there, it goes from 1 to 10 to 100 to 1,000 to 10,000 to 100,000 to 1 million. If it was to scale, we would need a very big screen. So the performance of the United States share market has been one of the highest performing asset classes in the world. If you aren't offering your clients international diversification in the global market that we now live in, globalization is a factor of life that we all should be accommodating and adjusting our clients' portfolios to account for. Then the performance of their portfolio would underperform the overall market significantly, as the Australian share market hasn't done that much over the last decade, where the US share market has skyrocketed. That's one of the things that Berkshire Hathaway does actually offer your clients, is international diversification away from the Australian economy, away from the Australian property market, away from the Australian share market. It does it through a globalized company where you can gain a large investment exposure without a huge outlay for your clients. So while the US share market has been a stellar asset class to own, Berkshire Hathaway has significantly outperformed, not just in the last 60 years, but the last 20 years, the last 10 years, the last 5 years, and the last 3 months. To give a bit of an idea of Berkshire Hathaway as a brand isn't well known because it doesn't really do anything in its own right. It is a holding company. Berkshire Hathaway actually employs under 30 staff directly. But as a company, it's the fourth largest company in the world behind Apple, Google, Microsoft, and Berkshire before ExxonMobil. As a company, while there's less than 30 staff at head office, obviously their subsidiaries, whether wholly owned or a fraction of their shares, Berkshire Hathaway holds, they employ hundreds of thousands of people. Warren Buffett's biggest investment holding is in insurance. At the last AGM that I attended in 2015, I'm heading back over there in a few weeks' time in Omaha in May, he was asked what's the most important investment advice he's ever received, and he said the most important investment advice he's ever received was to understand the insurance business. And it's not so much the insurance business where they underwrite different insurers around the globe. It's that when you're an insurance company, you have to hold a certain amount of liquid assets for the insurance that you write. It's called the float, just to ensure that you can pay out when any of your clients make a claim on their insurance policy. What Warren Buffett has become famous for is investing that float to create positive returns for shareholders. As brands that you might know, Geico Insurances, the one with the gecko. If you go to the United States, I think every time you turn on the TV, there is the gecko with some form of advertisement. BNSFF, Burlington Northern Santa Fe Railway, NetJets, American Express. American Express has been one of the greatest investments that Warren Buffett has held since the 60s or the 70s. He's held it for decades. IBM, which is more recently purchased. Kraft Heinz, the tomato sauce, again another purchase over the last few years. Coca-Cola, an investment that he's held for decades, where Berkshire Hathaway owns almost 10% of the company. Goldman Sachs, Wells Fargo, General Motors, Bank of America, Apple. They're some of the big brands that Warren Buffett owns. What Warren Buffett's philosophy does is that he's greedy when everyone else is fearful. My belief is the tightest man alive in that he looks for bargains. He looks for great opportunities, but only when those opportunities are priced at a discount. That gives him a margin of safety. So he looks at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. So over the last, since the GFC 2008, Warren Buffett has been presented with a lot of opportunity as people have been very, very fearful. Goldman Sachs invested $5 billion in what is arguably one of the greatest deals ever done in the last decade post the GFC. Burlington Northern Santa Fe acquired 77% of it. That's a railway in the United States, a pretty big one. Lubrizol, Bank of America, while Goldman Sachs deal was the deal of the century, he received a phone call a few years later from Bank of America saying, hey, we need some cash. Do you want to do the same deal with us as you did Goldman Sachs? And Warren said, you betcha. IBM invested $10 billion into it. Heinz, $28 billion. Kraft Heinz, 46 when they bought Kraft and combined the two businesses. $37 million for Precision Cast Parts. Actually, in 2015, he made his first ever investment in Australia in the insurance business. He took a stake in IAG Insurance Australia Group and agreed to underwrite a lot of their positions in return for 20% revenue share. While I'm a big believer in IAG and it's one of my share picks here in Australia, the deal was skewed in Berkshire Hathaway's favour. Then he bets on oil. As the oil price went down to $30 a barrel, he made a big investment in Phillips 66. Again, taking advantage of market folly rather than participating in it. When the oil price got back to $30, that was obviously on fear. He was greedy and made big acquisitions, and shareholders of Berkshire Hathaway have been able to reap the return over the last 12 months as the oil price has rebounded. And that is textbook Warren Buffett. You buy on weakness. And then increased his stake in Apple more recently. So over the last 10 years, many people have been sitting on their hands, not Buffett. He waits for great opportunities, and when they come around, he has a big swing. It's only when you have a big swing do you get big returns. Generally, though, the structure of each of these deals involves some form of preference share where the downside risk of owning equities is minimized. which is why the returns have been so stellar when the market has rebounded, yet when the share market's fallen, the losses have been minimal, simply because he doesn't take ordinary stock for the majority of these transactions like every other investor does. If you want to get access to Warren Buffett deals like he does, simply buy Berkshire Hathaway shares. So that's the AGM, annual shareholders conference, goes for 3 days. 50,000 people turn up. That was the 50-year anniversary that I was at in 2015, which was phenomenal. I was lucky enough to get a seat in the main auditorium. 3 hours before the gates open, that's the lineup to get into the convention center there at Omaha. Why this photo is very important is that on the right we've got Warren, in the middle we've got Charlie Munger, who's Warren's right-hand man. Then on the left is who I believe will take over the helm at Berkshire Hathaway when Warren and Charlie decide to retire. Bill Gates. So we're going to go from the second richest man to the richest man taking over. Now, that's not public information. I'm just having an educated guess that he is the man that's going to take it over. And I'll tell you why I think he's going to take over as chairman. Warren Buffett, he has donated 96% of his wealth, which is the shares in Berkshire Hathaway, to Bill Gates Foundation, to Bill Gates charity. So indirectly, Bill Gates becomes the largest shareholder of Berkshire Hathaway. Back in the 90s, the two of them met. Bill Gates was invited to be a director of the board of Berkshire Hathaway about 2 decades ago. So Bill Gates has actually been involved in the decision-making of the company as a director for the last 2 decades. When he inherits the company, or the Warren Buffett's share in the company, he will take a role as the chairman to ensure that the continuity of the business is maintained, similar to how Warren Buffett and Charlie have managed the company previously. But I think one of the key decisions that he's going to change is that the two people that have been so successful in allocating capital, allocating that $100 billion that they sit in cash, is Warren and Charlie. When they move on, they don't have those key people. While they have younger investment managers, and if you look at the returns of those younger investment managers, the returns have been superior than Warren and Charlie more recently. But why I think what's going to happen is that Bill is going to change the company from being an accumulation stock, an investment vehicle, to being a dividend-paying stock, is simply because as a foundation or a charity, if you inherit what is $50 billion, you can't initiate any change for the wider, broader good unless you've got cash to spend money on research and development to come out with a cure of polio, which has been one of the big drivers of Bill Gates, whatever it is in the future. He needs cash, and Berkshire Hathaway hasn't paid a dividend for a long, long time. I think Berkshire Hathaway has only paid 1 dividend in its entire history. If it's not paying out a distribution, then the foundation can't actually do anything. So when the key investment managers can't allocate the capital, I believe Bill Gates is going to distribute it to shareholders, distribute a lot of it to his charity, and then he can go out and initiate change. I think that's going to be the key driver of the Berkshire Hathaway share price over the next 3 years. Is that when they do retire, that could potentially happen in the next 3 years, the share price would have a massive increase due to it being a dividend-paying stock rather than a growth stock. This is photos that I've taken. We've got Warren on the right handing out the Fun Run medals. But on the left, again, if you look there, there's 2 people playing ping pong. It's Warren Buffett and Bill Gates. They're at the dinner afterwards, lucky enough to go to a restaurant, and Warren and Bill were there. Having dinner. Again, the 2 of them, it's Warren and Bill. These guys aren't just good friends. The reason they're hanging out together is Warren Buffett has been grooming for 2 decades Bill Gates to take over the chairman's role. Again, at dinner with their families. There we are at the AGM, a photo I took in a newspaper tossing competition, Warren and Bill. So when we look at the Warren Buffett way, company must have the following characteristics when they invest in any company. First and foremost, it has to have quality management. 2, that company has to have a long-term track record of providing superior returns to investors. Thirdly, simple and easy to understand business model. 4, trading at below intrinsic value. They're the 4 criteria that Warren Buffett looks at in a company, the main ones. For me, the company that represents all 4 of those is Berkshire Hathaway right now itself. Quality management, proven long-term track record over 50 years of providing over 20% return to investors. And it's a simple and easy to understand business model. It's merely an investment company. They employ less than 30 staff. Now, it's trading below intrinsic value, I believe, because of the uncertainty that overshadows the stock. It's a problem. A perceived problem is that they don't know what's going to happen to Warren or the company when Warren and Charlie move on. Warren's 87, Charlie is 91 or 92 years of age. So there's no hiding that in the next 3 to 5 years something's going to happen at the helm of the company. I believe once they announce that Bill Gates is taking over, the share price would have a massive uplift as people buy the stock on the projection that it's going to be an income-paying stock rather than a capital growth story. Also, once they come out with that news and that decision, people won't sit on the sidelines. A lot of people sit on the sidelines because of uncertainty. Uncertainty has overshadowed the stock on the basis of who will take over and what will the decisions in the business look like in the future. As soon as that uncertainty gets eroded, the share price generally has a massive kick north. So the reasons why I like the Berkshire Hathaway story right now, if you look at a political perspective, with the new president, Donald Trump, taking over, he's sending a clear message to the globe. That is, he's only interested in one country, and that is America alone. So if we look at the America story, if you want to gain exposure to the largest United States or the largest economy in the world, that is the United States, if you believe that even 50% of what Trump says is actually going to be passed through Parliament, then that's going to have a positive uplift, I believe, in the US economy, the US share market, and as a result of that, Berkshire Hathaway's profits and share price. So if you're looking at a way to gain true diversification internationally, then Berkshire Hathaway offers that opportunity. So there's a lot of key driving factors that should be beneficial for the Berkshire Hathaway share price over the next 3 years. This is why I've come out with the investment now. Berkshire Hathaway Tailored Investment Solutions Series 3 investment. Tailored Investment Solutions, look, we're an issuer of structured investments. That's all we do. We're transparent, we're innovative, and the key driver is integrity. When I say we're transparent, we don't make a management fee out of this investment. The only way I make money is a performance fee. We take 10% as a performance fee, 10% only. So if clients make 100 grand, we take 10, they take 90 in the end. There's no management fees. If there's no performance, we make nothing. Innovation, we're leading the industry for not just structured investments, but also self-managed super fund investments. This investment, you can invest not just outside of super in your own name, but also using a SMSF. So it gives us exposure, the investment, to Berkshire Hathaway, Warren Buffett's company. We gain exposure to the currency movements. That's only on any gains. So let's say Berkshire Hathaway goes up 10%, and the currency moves in our favor by 20%. The return to investors is 12. So it's 20% of the 10, which makes it 12% return to investors. Conversely, if the currency deteriorates and goes against us by 20%, the return is 8%. It's 10% less than 20% currency movement, so we get 8. So currency doesn't have a big impact on the overall returns. It just influences the gains, if any. There's 3 risk management strategies built into the investment. The first one is capital protection, which ensures that in 3 years' time, if Berkshire Hathaway has gone down in value, the clients can walk away from the loan. The loan is 100%. You can borrow 100% of the investment exposure amount. The effective fixed interest rate is 4.95%. For the currency hedging fee, the capital protection fee, that's 2%. You can borrow 100% for a self-managed super fund. Investors need to prepay 3 years of the interest rate and the currency hedging fee upfront. I'll go through the dollars amount in a moment. So we know exactly the amount of risk that we face upfront. Investors cannot lose any more than the interest and the hedging cost that they're paying upfront. Every quarter they can redeem. Every 3 months they can redeem, but that's more of a profit-taking mechanism. There's also potential for yearly income distribution as we harvest the growth along the way. We can pay out up to 10% of any growth at the end of year 1, the end of year 2 as a coupon. It's a 3-year term. So it's an example. Let's say clients want $100,000 worth of exposure to Berkshire Hathaway. Warren Buffett's company. So they take out 100,000 units, which gives them $100,000 worth of exposure to Berkshire Hathaway. The investment amount is $20,850, which is the prepayment of 4.95% being the interest rate, 2.2% currency hedging fee times 3 years. They're fixed. So the outlay is $20,850 for investors. Now, as an advisor, financial planner, you can then charge on top of that an advisor fee. You can charge whatever you desire to. You do need to negotiate with the clients. We collect that money on your behalf and pay it through to your dealer group. So the advisor service fee is $2,200. It can be zero, it can be $2,000, it can be $1,000, it can be $10,000. It can be whatever you negotiate with your client. Let's assume you charge $2,200. So the total investment amount is $23,150. Your investors pay that up front, and that gives them $100,000 exposure to Berkshire Hathaway for the full 3-year term. There's no future obligations, there's no payment. If the Berkshire Hathaway share price falls by 50%, there's no margin calls or anything like that because the loan is through a limited recourse borrowing arrangement. It is internal gearing. So $23,150 is the total outlay. Now, if the Berkshire Hathaway share price is up 50% over the 3-year term, that means $50,000 would be the payout. I take $5,000. Your investors get $45,000. So clients essentially double their money if it goes up 50%. It's due to that internal gearing and the limited recourse borrowing arrangement of the loan that we can get all the upside of borrowing without the usual downside risk that leverage encompasses. That's a total outlay, that's a total at-risk capital. So look, Peter and Anne, let's say it's a hypothetical client. They invest $23,150 into Berkshire Hathaway investment. It gives them $100,000 exposure to Berkshire Hathaway. The reasons they want the investment is to reduce the fees, where fees are correlated to return. 10% performance fee per us as the issuer, rather than just charging an annual MER. The MER is zero. They want to control their super, so set up a self-managed super fund. They love international diversification. They love the fact that they're now investing in Warren Buffett's company as the most successful investor of all time. Quantified downside risk, they know what their downside risk is. They love leveraged. The fact that it's a tailored investment for a self-managed super fund, they enjoy. The fact it's only taking $23,000 out of their super fund means that it's only a small portion, maybe, which means they've got a lot more capital to invest in other investment strategies, whether it be shares, property, fixed income, whatever you're advising your clients. So it's only a small outlay out of their back pocket, which means you're free to invest the capital as you wish as the investment advisor elsewhere, but it does provide diversification. This is an investment that's going to be offered through AMP or their banks. So it gives you the ability as the advisor to go to the clients and go, hey, here's a great investment that you should look at. It's only going to involve a small outlay, but you've got exposure to the world's most successful investor. Same time, you get leverage. The past performance means that the average return has been 95%. So it's a great value add for you as a financial planner to differentiate yourself from the people down the street. Key risk, there's no guarantee the investment will go up. While the past performance has been stellar, Berkshire Hathaway goes down at the end of year 1. Down at the end of year 2, there's no coupons, and it's down in the 3rd year, there's no payment. So in that example, Peter and Anne can lose $23,000 if at the yearly anniversary, the 2nd year anniversary and maturity, Berkshire Hathaway share price is below the initial average commencement value. The performance is affected by the underlying asset, which is Berkshire. The counterparty risk is an investment grade bank. There's a performance again, average past performance 93.58%. So I've been doing this for quite a period of time. This is my first rodeo. Over time, I believe I've improved the structure by enhancing the returns. There are only minor adjustments really. It certainly wouldn't reduce the returns there on the screen. A lot of people say, what happens if he passes away? Now, the only company I think is similar to where there's been such a key person involved in the company is Apple with Steve Jobs, as we've got Buffett with Berkshire Hathaway. Now, Steve Jobs, he wasn't 87 years of age, but for a long period of time he suffered from cancer. We knew it was inevitable he was going to pass away. And a lot of people sat on the sidelines not buying Apple shares because they thought if Steve passed, then the key person has moved on, the share price will fall. But in fact, the exact opposite happened. Steve Jobs passed away on the 5th of October 2011. Apple share price was up 72% 12 months later. The reason why I believe that's the case is that people feared the uncertainty. Once the uncertainty was over, he was just one person. The business continued as it was previously, and the share price increased as people bought the stock. I think Berkshire Hathaway is going to be a similar sort of performance, I believe. Once Warren retires or passes away, the share price should increase dramatically as we realize that Warren Buffett's involvement in the underlying companies that he manages is very, very low. Like Coca-Cola, Warren Buffett doesn't dictate the decisions of Coca-Cola. Wells Fargo, IAG, Goldman Sachs, Bank of America, Geico. Warren Buffett does not make any decisions of those companies. So the profit of Berkshire Hathaway should be just as strong as what it has previously. Obviously, what Warren does do is allocate the dividends that all the companies he owns to future acquisitions. He's got two guys that have been doing that now for a fair few years underneath him for a small amount. But as I said, when Bill Gates takes over as chairman, I believe he'll change it from being a investment company to an income paying stock. So they don't need Warren there as they pass through the profits to investors. So that's it. That's the reason why I'm coming up with the investment. Look, my belief as an investment manager, my job is to pick the underlying asset that I believe can go up the most. And look, for 50 years, who could argue that Berkshire Hathaway has been the most successful and investment company in the world? Warren Buffett has been the most successful investor in the world in the modern era. So the investment is open now. Look, contact me for a copy of the product disclosure statement. Maybe it was attached to the email. We've received this quick presentation that's gone on for a lot longer than I anticipated. It does close on the 11th of April, which is in a few weeks' time. The direct debit date is a few days before that. However, the commencement date isn't for a few weeks following that close date. So we do have the ability to accept late applications if you need to submit them. So look, thanks very much. If you've got any questions at all, please contact me. You can contact me individually, personally, on my mobile. It's 0428 312 502. So thanks very much for listening. Look forward to hopefully working with you and your clients in the future.